Hey everyone, thanks for joining me. Today we are going to take a quick dive into another Forex British Pound USD short trade. So let's get the ball rolling. Now, as day traders, we know that no two trades are ever the same. In fact, every trade is a new way to win or lose. That's why it's important to stay on your toes and know how each type of trade works. With this particular short trade here, a good place to start, in my view, is with a 1 hour chart. I think that in this specific time frame, we can certainly analyze the market and use that data to project upcoming trends. Keep in mind, guys, that experienced traders are able to participate in the market cycle by understanding where it stands presently and having an eye towards which direction it is headed next. Once you have predicted the market's path, you can then begin executing orders with a certain level of confidence. And I know that some of you hearing this will say, well, Undercurrent, the problem is that predicting the market's path is easier said than done. Well, not necessarily. I tend to disagree with that assumption because we know that price movements occur on two specific market cycles, which are, as you know, consolidation and trend. Knowing which side of the market you are dealing with at a given moment is key to predicting where it takes you next. So by understanding these two distinct cycles, whether you are in balance, which equals consolidation, or imbalance, which equals trend, you can gain a better insight into the likely direction of the market. Armed with this higher level of knowledge, and by the way, guys, I'm not talking here about the way conventional technical analysis teaches everyone when it comes to identifying market turning points. My suggestion here is strictly Wyckoff based. So equipped with this advanced understanding, I'm sure that you will be able to navigate the market's ups and downs more effectively. Now, in the 1 hour time frame, we can clearly observe the market accumulating down here, following this distribution and nosedive periods. Obviously, this bearish order block within this sideways price action is a strong indication of potential market movement, especially when combined with the pair's failure to make higher highs here or even test the order block ceiling, which, as you can see, coincides with this resistance level. Even more intriguing, however, is the market's break of formation or break of structure here that makes me further ponder what may be ahead. And you know, speaking of market structure, for those of you who are new to day trading, allow me to briefly explain first what market structure is and then how is market structure broken. Basically, the market structure consists of different key price levels that are formed when a currency or security's value fluctuates. Price, as you already know, never remains static. It takes a few steps forward and then several back before continuing on its path. Over time, these varying price points form well-defined trading structures such as consolidation zones, support and resistance areas, or regions of up and down price movements, which, when formed in the past, and this is important to remember, guys, when formed in the past, are often respected by markets and therefore have the great potential to determine viable trading opportunities for traders. Obviously, understanding the concept behind market structure and the ins and outs of this crucial trading pattern can really help you as a trader establish a foothold in your trading strategies. Okay, with this part explained, let's now briefly talk about how the market structure is broken. Well, when the price breaches a level that it had previously respected, we can recognize that the existing market structure is broken. In particular, these breaks of structure are most easily noticeable when prices break out from consolidation areas. Other times, a break in market structure can emerge when prices break through an area that has been respected and held as strong support or resistance over an extended period of time. While there are many variations out there, these two types of market structure breaks remain the most common. Obviously, when a bullish break of market structure occurs at the end of a downtrend, it is an indication that the prices are likely to rise. On the other hand, when there is a bearish break of structure following an uptrend, this may be indicative that prices will fall. Guys, basically the idea here is that if you want to get a better understanding of how the market functions, it's important, I think, that you study how price acts in relation to market structure. If you want to become an advanced and obviously a successful trader, then please do take the time to study this relationship. Alright, getting back to our trade now, and as I was saying, what's even more interesting in the 1 hour time frame is the fact that a market has broken structure here, which leads me to speculate what might be waiting ahead. So with that in mind, let's transition here to a 1 minute time frame for a more refined analysis of this trading range, which obviously now becomes our point of interest. And as you can see in the chart, the first thing that captures your attention after the switch is this bearish order block, which seems to imply that the market is not ready to be marked up. And at first glance, this may seem like bad news, but it really demonstrates, in my view, an underlying short-term strength in price. And obviously, here the question would be, well, undercurrent, what is the basis of your assumption? Well, because I think beyond the fact that order blocks often form near the highest and lowest points of an asset's price range, in this case, we can see signs of a ranging market with a nice temporary base in place, rating itself via these demand bars for a retest of the order block source domain. Also, keep in mind that accumulation phases involve the purchase of a security by smart money at lower prices and monitoring advances in price with short sales. So these elements make the possibility of a short trade, in my view, highly probable. So at this point, I think that all we've got to do is wait for the right cue. What I mean by the right cue is that the ideal entry point, always in my view, would be when the pair drops below the order block's base here, after failing to pump through this green horizontal line, which, as I already mentioned, represents a break in market structure on the 1 hour time frame. My main point here, guys, is that in this price movement zone, patterns like order blocks, break of market structure, and the accumulation aspect of low-priced inventory by smart money in anticipation of the next uptrend appear to be strongly correlated. If you can easily identify such important trading patterns and, most importantly, understand the different nuances between them and use that higher knowledge to your advantage, then that's a pretty strong sign that you are already on the path to becoming a successful trader. Now, as far as the trade's price targets are concerned, obviously, to maximize my gains while minimizing risk, I would set an 8 pips stop loss with the potential to garner up to 27 pips based on these targets. Alright guys, I sincerely hope that this video was helpful to you, and if it offered any insight at all, I'd be very grateful if you considered clicking the like button and subscribing to my channel. Thank you, and until next time.